Ibrahim Adepoju, and I am the CEO of Times. And in this first episode of our podcast, the Future Ledger podcast, we are going to be picking one thing that we know that is very, very important to every business, which is revenue. And the part we're going to be looking at is how can you automate the recognition of your revenue. Sometimes we think revenue is just selling, but there's still a lot of things in accounting that we need to know, and there are possibility of automating these things so that we get it from straight. And in this first episode, I'm with aka Ibrahim, Mr. Qudus Balogun, and I would love him to introduce himself. He is someone that is very passionate when it comes to artificial intelligence, automation in the accounting space, and we are taking this advantage to tap from his wide range of knowledge and get to understand the collaboration between AI, CFOs, and the accounting profession. So, Mr. Adepoju, Ibrahim, would love to know more about you.
Thank you very much for the privilege to join you on this particular podcast. Before I even go ahead to introduce myself, I feel like this is a very necessary one because, like everybody know out there, many of the accounting software that we have out there is usually garbage in, garbage out. And with the help of AI, I believe it's going to be a game changer. So before I go forward, my name is Qudus Balogun. On the street out there within the finance and accounting world, people call me Ibrahim. I've been in the accounting space for almost a decade now. I've worked across diverse functions within the accounting and finance space, from being an audit trainee to working as a junior accountant within the FMCG space to working as an account officer within a real estate organization to working as financial analyst and operation analyst, one of the biggest financial institutions in the country. Also, most recently, I've worked as manager financial planning and reporting, senior finance manager, reporting across several jurisdictions, the UK, the US, Kenya, South Africa, Ghana, to name a few, with one of the biggest edtech company in Africa, so to say. Also, I've worked within the fintech space as well, working to help restaurant businesses to automate their processes. And like you said, personally, aside from the fact that I'm very, very passionate about anything accounting and finance, I'm equally passionate or even more passionate about, or let's say, how accounting and finance processes can be automated. So right now, I lead Ibrahim Consulting, of finance and accounting professionals providing finance transformation services to discerning clients across the globe. And one of the key things that we focus on at Ibrahim Consulting is finance process transformation. So we believe that the mere fact that you can do something doesn't mean that you should just continue to do it the way you have always known it to be done, but rather to innovate around how it is being done, right? Because we believe as finance professionals dealing with numbers, automation is actually very key to our processes. Why? One, it reduces the chances of error, right? Humans are bound to make mistakes from time to time, but with automation, it reduces the chances of error. Also, it helps with audit trail. So, for example, when you automate processes and say that a requisition processes, for you to get any expenses disbursed, you need to ensure that there is a support document. With automation, clearly, when this support document is not there, you are not going to get that disbursement. And when this support document is there, it also keeps that record for future referencing. Also, it helps with internal control processes. With automation in place, it means that there is a greater level of control, and the accuracy and reliability we are able to place on financial numbers or the financial goals by users of financial information, it's a lot greater. Auditors have lesser things to worry about now, and equally business owners can trust the numbers within their system. Yeah, and I think summarily, one of those things that we say at Ibrahim Consulting is that if you are working on anything, whether in Excel or Google Sheets or any form of spreadsheet, if it is taking you too much time to get the job done, that means you are not doing it in the most efficient of manners. So technically, we are very passionate about automation, artificial intelligence, and anything that make life and work easy. Thank you.
Yeah, thank you so much for that. I think the synergy is very, very strong, and I'm very passionate about this too. And I feel like this will be a very interesting conversation because I personally, I lead the team at times. And, every day we sit down with accountants and we are cracking our brain. And we want to do that thing that you just said, that if it is taking too long, then we are doing something wrong. And, we view the Times accounting software, even with all the automation, we still question ourselves that no, we want to give people the power. We want to give the accountants the power. And that was what led to we building Times AI. We don't just want people to be dependent on the software. We want them to have control. Build something that they can speak to in the way they want. Like we want the software that will dance to the tune that you're playing for it. And I really see that there's a lot of things that both the technology and the finance side can really achieve. But what we just need to do is to have control. We want the accountants to be in control of what they get from the software for it to be very valid. And as I said, today we want to look at accounting is very, very broad. And if we want to start looking at automation across all the accounting space, on this call, I think 20 years we're still here because at the point we see people that will come into debate with us and say, "Oh, you guys from this call you've chipped into a path that we need to, we need to call you and tell you that no, this is how it's been done." Yeah. So, but for today we're going to be looking at revenue recognition, as I said. And my first question here is I first want to understand. I want you to share with us what are all the most possible ways that a business, an accountant, or CFOs can tend to recognize revenue from when trying to account. So what are some of the possible revenue recognition methods that you know? Just shed more light. Tell us something that we need to know. Thanks.
Okay. Thank you very much for that question. So when it comes to revenue recognition, because revenue is one of the most important line item within the financial statements, right? It technically means that there is a need for greater level of regulations around it. And why? Because this is number one item that any users of general purpose financial statement is going to be looking at when making decisions, whether or not to invest, to buy, to sell a particular businesses or a particular investment. And as such, there is a guideline for recognizing revenue within the accounting and finance space, which is guided by IFRS number 15. IFRS 15, issued by the IASB, International Accounting Standard Board. IFRS here is International Financial Reporting Standard. So we have IFRS 15 that is meant to guide the way and manners at which we recognize revenue, such that no matter how tricky the business idea, the business concept gets, for you to easily be able to recognize the revenue and be very sure that yes, this is correct, all you just need to do is to place it on the yardstick of IFRS 15. What does IFRS 15 says about recognizing this kind of revenue? So number one thing is even that for general revenue recognition, let's even start from basic buying and selling. From basic buying and selling. So you are into selling of provisions, and then you want to sell to Iwelabi. Iwelabi has come to your store to buy a provision, and this is cash on spot. So this is an exchange, an on spot exchange of transaction. So according to IFRS 15, before revenue can be recognized at all, there is a 5-step model that you need to consider, right? And what is this 5-step model talking about is exactly what we are going to be demonstrating with the provision store. So we have a provision store that is owned by Ibrahim, and then Iwelabi walks into the store. He wants to buy, let's say, an Apple iWatch, basically an iWatch. So you will have to get to the store to buy an iWatch, and then the next thing is you will be priced, and before you know it, Ibrahim tells you will be this is the price, and then you will be pays, and then Ibrahim issue will be an invoice and a receipt at the same time, and then before you know it, the transaction ended. You will be leaves the store. You see what just happened here? IFRS 15 basically explains how exactly revenue is to be recognized based on what has happened. Number one is that for you to recognize any form of revenue, there must be a customer, right? And that is why IFRS 15 is saying that you have to identify the contract with a customer. And why is this? In order to avoid fictitious numbers into the book. I mean, I don't want to go into the details, but as much as possible, there must be a customer for you to say there is a revenue. You can't transfer from one of your bank accounts to another bank account and saying that you are recognizing revenue. No, there must be a customer. So we have to identify the contract with a customer. And now, what is even a contract, right? A contract is an agreement between two or more parties that create enforceable rights and obligations. And technically, you will be walking into the store, and then the next thing, what can we see as a contract here? If you will get a receipt out of that store, it technically means that Ibrahim store has said, I have transferred ownership, or Iwilabi has paid for XYZ. So there is a difference between receipt and invoice now. So typically the basic difference is that receipt evidence payments for a particular transaction, while invoice evidence transaction that a particular transaction has occurred, right? So in this case now, to cut the long story short, there is Iwilabi, who is a customer, and there is the Ibrahim, who is the seller. Number one thing is there must be a customer. One. Then the next thing is that we must identify the performance obligations in the contract. In this case, there is a performance obligation in every form of businesses. And what does performance obligation means now? It technically means that whatever you are selling or you are buying in terms of exchange of value, that value you are giving out to get a consideration that can be either in form of cash, shares, equity, or even exchange of another service. What exactly is the value you are giving out? That value you are giving out is what we call performance obligation. In this case, the iWatch that Iwilabi is buying from Ibrahim's store is what we consider as the performance obligation. That is, at the end of the day, Ibrahim must pass the iWatch to Iwilabi, and that is the performance obligation that you have up there, right? And then the next thing is that we are saying that once you identify the performance obligation, right, determine the transaction price. What exactly is the transaction price? And this is a common mistake with some startup founders, right? When they go, maybe they are just starting, at the end of the day, they start giving out their products without a specific pricing, and before you know it, they want to recognize revenue. No, it doesn't work that way. There must always be a standard transaction price, right? What is this transaction price for so what is the transaction price now means that how much are you selling this iWatch? iWatch is $5,000, right? That is the transaction price. Then the next thing is that allocate the transaction price to each performance obligation. There are instances and situations where we have more than one performance obligation within a transaction. What do I mean? So you are selling an iWatch, right? But you're saying that if you buy an iWatch with me, I'm going to give you an Apple AirPod as well, right? You see, in that case, when you are recognizing revenue, even though you are giving the Apple iWatch free, the ideal thing is you have to allocate the amount of that iWatch and the Apple AirPod. I mean, this time around, we are going to be doing the allocation in terms of, what is the total amount of both the iWatch and the Apple AirPod together, then to get what belongs to, or what we can call the pricing of that Apple AirPod. We divide Apple AirPod price divided by the total amount that we of both, right? And then the other two. So in these instances, or let's even say you are selling them together with their individual transaction price. So iPod is $5,000, let's say $5,000, then iWatch is also $5,000. In this instance now, what that technically means is that when you are issuing your invoice or when you are recognizing your revenue, you have to recognize them separately. iWatch, you sold iWatch 5,000 naira, you sold AirPod $5,000, right? So both $10,000 now, and that is what we want to see in your book, right? And then the most important thing now, before you can recognize revenue, we have to ensure that revenue is recognized when a performance obligation is satisfied. When a performance obligation is satisfied, that is when you eventually give Ibrahim the AirPod or the iWatch, that is when you can recognize revenue. So this is for in particular, let's say buying and selling, and this is quite straightforward. It becomes tricky when we start looking like businesses like Netflix, MTN, and what have you. And how do I mean? For example, a typical Netflix, right? If you ask a typical, maybe accounting student, what do you think the performance obligation of Netflix is? You probably might struggle to even understand it, right? Why? Because for a Netflix is running a software as a service business. And because they are running a software as a service business, and in many times, they do not necessarily always issue you the physical receipt, the physical invoice, or you signing a contract. However, in the process of signing up for a particular platform, you're already clicking some things and all of those things which are synonymous to contract that you're signing, right? And in this case, for a typical Netflix as well, they typically also get money from you in advance. And then when they get money from you in advance, this is where the trick, this is where it becomes a lot more tricky. And how do I mean? Netflix has gotten money from you in advance. The IFRS 15 says that before revenue can be recognized, you must ensure that the performance obligation has been fulfilled. Now, it begs for a question to say that you paying Netflix in advance, does it mean that Netflix has the right to recognize revenue? The answer is no. And then we now wonder, how do you then expect Netflix to recognize revenue? What is now the performance obligation in this instance? Let me enlighten us here. The performance obligation here, when it comes to a typical transaction between you and Netflix, is that Netflix must be able to provide you access to their platform for a particular period of time that you have paid for. And as such, Netflix recognizes revenue as the day passes by within that particular duration. So you pay for a 3-month plan or a 1-month subscription with Netflix, right? The ideal thing is that Netflix is going to start recognizing revenue right from perhaps the day that they give you the access to the service. I mean, I've seen startup businesses, most especially B2B, that struggle to be able to pull some of these things off. Why? Their business models usually involve having to onboard. See, this is where some of the problems are, right? If you are having to onboard clients on your business, whether on your app, whether on your web, whether anywhere at all, as long as you have not fully onboarded the client and the client has been started enjoying the service, according to IFRS 15, you do not earn that revenue. You do not have the right to recognize that revenue as it has not been earned. So in this kind of a situation, technically, you have to ensure that you onboard first. And when you onboard, the client starts using the platform first, you provide access to the platform. And I mean, use the word using. And this is also tricky. There are some businesses that you have to use, or your customers have to use before you can recognize revenue. And there are some businesses that whether the customer uses or not, you can recognize revenue. And this is where the performance obligations fall. So some businesses, the typical MTN, performance obligations is that as much as I want to call, I must be able to use my airtime to make call. And until I use that airtime to make call, MTN can't recognize that revenue because it hasn't been earned. Unless in some instances where they are selling to bulk buyer and all of those things, then that now becomes like a B2B. And as soon as they provide to that B2B service, you know that is off the book before we get to the B2C or B2B2C and what have you, right? So that is a typical MTN. Very funny and tricky one. Then a typical Netflix, to wrap it up, a typical Netflix is expected to say you have paid. I am only going to recognize revenue as long as you have access to my platform. So the performance obligation here is that Netflix has to make the platform available for use for the 30-day period that you have paid for. Whether you now watch it or not, it is not Netflix's responsibility for you to watch, for you to view, for you to use. Netflix's responsibility from Netflix business model point of view is to provide access to that platform, similar to DSTV. And that is why some people will claim, or some people will call for pay as you go. Why? Because, I mean, a Netflix, a DSTV are saying, bro, it is none of my business Whether you use or not, as long as the platform is available for your use, I am going to be getting the money and I have that right to recognize revenue. Then what can stop Netflix from recognizing revenue? When there is a general issue where you are not able to access that platform, then yes, Netflix can't recognize revenue. And in this kind of situation, then what do we have? Where you have paid Netflix, what would be the journal entry? You have paid Netflix, but we are saying Netflix can't recognize revenue. Then what do we have? In this kind of a situation, we have something that is called contract liability, where you have paid 7,000 naira for Netflix premium, and at the end of the day, Netflix doesn't have the right to recognize that 7,000 naira as revenue until the duration you have paid for lapses. And what does that mean? When you pay to Netflix 7,000 naira, technically we all know that when you are receiving a payment as Netflix, you are going to be debiting your bank. Now the next question is, where do we credit? Where do we credit? Technically, Netflix is meant to credit contract liability. And why is it a contract liability? Because now you have gotten money from someone that you have not provided service to. And as such, you can't recognize revenue. Going to startup terminologies and some of these fintech, SaaS business terminologies. And that is one of the reasons why we have sales bookings different from earned revenue. And some people also use this to differentiate between sales and revenue, even though these two terminologies can be used interchangeably, where there is no need for distinction. However, in businesses like SaaS businesses, there might be a need for you to say, this is the total monthly sales that will close this month. However, not the same as the revenue earned. To wrap it up on revenue recognition, let's go to the complex part, which involves the real estate and the construction contract and the construction services. And why is this interesting? Imagine a situation where you engage into a business with Times Construction, right? We have Times Construction, a real estate constructing firm, and Ibrahim Consulting has reached out to Times. Please help us with building our new office. We are looking at a 10-story building. Truth of the matter is, unless the 10-story building is fully completed, we are not going to pay you your money unless you finalize on the 10-story building. So why is this tricky? Times, guess what? If you build up to 8-story building, guess what? You are not going to be having a receivable, and you are not going to be getting anything from Ibrahim Consulting. Why? Because the contract now has something we call a condition, and we are going to get there. I've spoken about contract liability, which is the fact that you've received money in advance for a service that you are yet to be rendered, or for a performance obligation that you are yet to fulfill, right? Now, in the case of construction contract and what have you, then we have something which is recognizing revenue over a time period basically. And how does this work? Imagine that. So as times that the Ibrahim Consulting has said, we are going, and this is common with government contracts and some big contracts, where you have to use your money as a contractor to fulfill the business obligations before you get paid back, right? And some instances, probably you get just 20%, and then you have to use your money to fulfill the rest. In this kind of instances, because the construction activities is going to take time, or is going to take over a particular period of time to get completed, how do we then recognize revenue? So you have a business of 50 billion naira, right, to build a very solid and magnificent power for Ibrahim Consulting, right? And this is not something you can do within just 2 months, 3 months. This is something you have to do over a 3-year period of time. How do we then recognize revenue? And we know the amount. The amount is 50 billion naira, right? How do we then recognize revenue? There are 2 ways to recognize revenue in these instances. We have the input method and the output method. And this is also part of IFRS 15. That probably is not so common. And why? Because, except you are into that side of business, probably might not. So we have the input and the output method that speaks to the fact that, look here, because of the fact that this thing is going to take time and you're already working, right? Even though you are not necessarily getting money at the immediate, there is a need for you to recognize revenue because you're already working. Because you're already working, there is a need to recognize revenue. Because we say that the revenue should be recognized when performance obligation is fulfilled. But this particular performance obligation takes a duration of time before it gets fulfilled. What do we then do? We have to recognize revenue over time. And how does this happen? We can use the input method or the output method. Input method speaks to the cost you are incurring, right? Cost you are incurring. So that you are incurring the cost and you're doing the job, you are leveraging the costs to recognize your revenue, right? Then there is the output method that speaks to where the job is certified over time. So there's an evaluation that is done, and then you have a certification of particular percentage completion. So they say, oh, from now to this place that you've done, this is what percentage of work certified has done. And as such, based on that, you are able to recognize revenue. I don't know if this makes sense. Right. So to cap it off, right, for the purpose of automation, this is where interesting times now come, right? For the purpose of automation, we have a situation, or currently the way Willoughby Consulting manages it for our clients and some other businesses is, number one thing we track is for some businesses that the business model involves having to receive money in advance before they now deliver the services or fulfill the performance obligation. What happens here? As much as possible, we focus on the amounts received for the amortization. So there's something we call revenue amortization, right? Why do we have to amortize? Because we know that this particular revenue is going to also be earned over time, even though you have received money in advance. And this is where we have contract liability, also known as deferred revenue. Some people call it deferred revenue. This is also the same thing with contract liability. And also very similar to deferred income. In this kind of a situation, what we just focus on is what exactly is the cash element that you've received, right? And what is the invoice amount of what we are talking about here, right? And we just divide based on the cash element that you've received and the invoice amount. So we literally just automate the processes in such a way that we focus on having a spreadsheet that contains all the money that comes in, right? And then based on the plans that we're looking at, then we amortize. Is it divided by 3? Is it divided by 6? Is it divided by 12? And once you amortize, there are a couple of functions on Google spreadsheet that could be written just to automate the process. But it starts from identifying cash elements. But in the situation where it is just as it is happening, you are transferring it. As it is happening, you are transferring it. In this kind of a situation, all you just need to know how to ensure to do is to get your journal entries correct. Because as it is happening, you are giving out the services. But there is one bit that is usually very confusing to people, and IFRS 15 has explained it, which is what is the difference between receivable and contract assets. Receivable and contract assets. Contract asset is not an everyday thing. In fact, I could almost say that there's probably, you rarely find it in any accounting software where they are accounting for contract asset. Why? Because it is not so common. Remember I said earlier on, you are building a tower for a Willoughby Consult, 10-story building, and then at the end of the day, you are probably stopping at 8. Or in Willoughby Consulting has said, unless you finish the 10-story building, you are not getting paid. Here, a typical receivable is that when you render a service to someone where the person did not pay immediately, you are going to credit your revenue and you debit your receivable because you have rendered the service and the person didn't pay immediately. And what is just stopping you from receiving your payment is just passage of time. Just holding on for where the person is going to pay. But there is the contract asset where you have used your money to engage and fulfill a part of the performance obligation or a performance obligation that is tied to a condition. For example, I'm saying that unless you complete a 10-story building, you are not getting anything. So in that case, the money that you have used to complete 8-story building, where they are going, as you are crediting your revenue, you are going to be debiting your contract assets. Because until you complete the 10-story building and it is now certified that yes, this is what I want, right? Then you are now going to say debit your receivable and credit your contract asset. That is when you are going to be moving from contract asset to receivable. Technically, contract asset is tied to a condition, or I can call it a receivable that is tied to a condition being met outside the performance obligation. A receivable that is tied to it can also be within the performance obligation, but that receivable is tied to a condition other than passage of time. I hope this speaks to some of the ways and manners that we can have revenue recognition.
Yeah, I think this is very detailed. I can call this ACC 909, or something.
Yeah,
I see the primary objective of this call is the education part of things. We as a technologies, we leverage on knowledge. We try to build on knowledge, and a lot of things you see. I'm looking down. I'm taking notes at the point. I never pictured I'll start taking notes also on this call, for myself. And this is a very amazing thing. And there's something that there's a hierarchy I was able to sketch, and it's all starting from IFRS 15. Which you lay a lot of emphasis on, and I see that there's something common about the two examples that you give, which is the performance obligation. Because I feel like any business owners, even any accountant, anybody that is taking a look, watching this podcast or listening to this podcast needs to first understand this performance obligation. If you get the performance obligation wrong, you will not get the revenue recognition right. So that's just it. So if you want to learn more about everything we have been explaining here, either reaching out to Willaby or so, you just need to ensure that you have a very solid knowledge of the revenue recognition. There's multiple, industry or segment. And today we're able to look at the retail business, buy from me straight. We're able to look at the real estate business where you're dealing with contracts, with a kind of payment based on percentage or completion. And, these are a lot of amazing things. Thanks so much for sharing these, Willaby. And one of the things that we also try to do at times is when you look at invoicing, many invoicing softwares, how there are some scenarios that were not put into consideration, because you also make a good differentiation between receipt and invoice. And many people don't know. Many people just see, can I do invoicing on your software? Any little thing, everybody just, let me create a receipt, let me create an invoice, from the perspective of being able to get us to understand the receipt of the payments and the evidence of transaction and the receipt of the payment, to differentiate these two, makes a lot of sense. And now there are some times whereby type of transaction you are performing, you get to let us know that the revenue is not meant to be recognized immediately. And this is one type of feature that we have on times where we allow users, when creating an invoice, to split the account. So normally, if you're creating an invoice, you are meant to be selecting maybe a revenue account for the invoice, but possible that even when the customer still pay for that invoice, it's still not meant to be in your revenue account. So we give you the flexibility to provide a split, like, okay, 0% is in revenue at the moment, for the 100% in this my liability account, which you give us different examples, like the contract, the contract, what do you call the name? The contract liability, which I know as deferred revenue, and stuff like that. And this is really amazing, because most of the time, I feel like what some people will do is they use a kind of accounting software where they have to still put it in revenue, then look for a notebook somewhere or one spreadsheet to note it down. But at the end of the month, it might get confused when the payments come. But automation is being able to do the same thing on a single system, such that the day I'm coming to record this, I'm seeing that this transaction is showing me 0% in revenue and this percent in liability, and I need to, update the entry. And I feel like this is very, very amazing, because personally I've gotten a broader scope of revenue recognition from this call. And this is something that a lot of funders like myself still need to learn, which will really help us, so we don't have to be running ahead of vanity metric. Because there are some times whereby a customer just pay you a deposit for let's take, for example, there's a feature that you are meant to implement on your software, but you just let the customer to know that, you need to give us a particular deposit upfront for us to build this feature, so that by the end of Q3 we'll know you are serious and to use it. But if you look at most income statement of many tech startups, for example, you see they've already put the money there, and let the investor know that
very correct.
And stuff.
In fact, I see a situation, there is a very common one. There is an India edtech startup, the biggest edtech startup in India, also made this kind of mistake sometimes back, where at the end of the day, during the audits, their auditor had to slash their revenue by 40%. And that is because they have went ahead to, they've gone ahead to recognize revenue that are yet to be earned. And this is actually something that shouldn't be really confusing, but because it can be quite tricky in nature, right? And why is even this standard saying that you shouldn't recognize this revenue when it is not yet earned? Because what if the person wants to get a refund? What if I'm not interested any longer in the contract, even though I've paid? So what do we do? So this is some of the reasons why we are saying that, look here, as much as possible, for you to recognize revenue, you have to look at IFRS 15. I mean, I've worked with fintech startups as well. And some of the problems that I've seen with many startup founders is also that because they've received the money, right? I mean, and it can be quite tempting. You agree with me? I've received a 50 million naira, or I've closed a deal of 50 million naira. And then at the end of the day, you are telling me that it's only 1 million naira that will make it to my financial statement. What? And this is the solution I had for them. I say, look here, management accounting wise, right? You can always show your sales book for the period, that this is the number of efforts that has been made for the period, right? Why you show your revenue separately in your income statement. And I mean, even this particular contract liabilities also goes to your statement of financial position at the end of the day, right? Also affects your cash at the end of the day. But I mean, for many investors, they are looking at the top line. What are we saying first? And that's one of the reasons why I tell exactly. I advise startup founders, look here, just report 2 metrics. Report your sales bookings, report your revenue. Most especially for fintech companies, where many times you have to provide the access for this particular platform to have access to your platform, and you are betting on the transaction volume and what have you and stuff like that. And before this thing eventually comes to play, you know that investors are also not patient about all of these things at some point. So because of that, they quickly want to recognize and earn this revenue, but it doesn't always work that way. And talking of automation, right, I feel like Kant is already doing a very great job in that regard. And this is also one of those things I tell my people when it comes to. So typically, you mentioned something about the fact that automation is being able to perform the same or similar activities within a particular system, right? And this is also even what we've been trying as much as possible to do for some of our clients at Liability Consult. And I've seen a situation where what you just said, many people are not doing it, and because of that, it's landed them into serious trouble, right? When we're having a situation where somebody has performed a particular, they've prepared an account, and the support document for that account is in another work entirely, which we that we are reviewing the account don't have access to. So imagine that kind of a situation. And in that instances, we are not able to provide support for many of the transactions that has happened. And then now what needs to happen is trying to figure out what happened this period, what happened that period. But with everything within a particular workspace or within a particular system like Times, then you can be very sure that, oh, okay, yeah, I know how the split is. There is a trail, there is a record that can be downloaded, and we can see how everything has been done. And this is the back end of, I use this percentage as this, I use this as that. And I mean, that kind of give confidence to the users of financial information.
Exactly. I think that is there's something that I believe in is that we humans, we are machine, but we try what we call machine are things we feel like are faster and quite better than us, but we are still like the smartest machine. Our limitation can just be speed. That is my understanding, over the past years of building stuff. Because when we build stuff, it's human that is building that same stuff. We're just trying to build something to be better than us. Even though there was a belief that AI at some point to start building itself. AI is writing code now, but either way, we still train the AI. Human can go into the system and still tamper with the algorithm or the model and let it start malfunctioning, So at the end of the day, one thing that we are very much advocating right now as Times is the fact that different accounting is a feed and deals with data. And when we are looking at technology is of very high relevance in a system that deals with data. For example, we're looking at a kind of transactions whereby you need to have your documents also attached to the system. Because one thing is like there are sometimes that contracts, you said like, for example, a contract with Netflix might be like you clicking on some buttons, but there's some transaction whereby there was a paper, there was a document, contract. When you are keeping your record, it's also good to tie these contracts, to that particular system. And one thing that AI make possible, or ML, is like we are moving to a stage whereby I will start talking of some of our visions at times, because we are not looking at this thing from a very small picture. We don't want people to just see accounting as they feel like accounting is changing. I should be able to be looking for information on my system, on my database, like, what's my ledger like, what's my transaction like this time, and I should also be seeing feed from the document that I attached, giving me an example to know why I'm able to perform this transaction. And these are some of the things that artificial intelligence can also help with, especially that documentation is very important. And, it's also make the work of auditors very easy, because right now it's becoming a problem, but sometimes we don't believe some things are a problem because we do not see the solution to it. So we just feel like that is how it's meant to be. But right now, when you see a lot of book, when you log into some people's accounting software and you look at the whole of the revenue and you ask like, who is the professional account? You want to know who is your guiding this? And we the founders, we are like business person, we don't know, we only know what they tell us. And when crisis arise or something arise, then they bring the big boys in and they start checking the group and tell you that but it's not meant to be. This podcast is not just about the business owner, it's about also with the accountants, the CFOs. We believe that knowledge is something that we need to share, and anybody can develop on this. And this will save a lot of life. Because you guys are like doing surgery, for someone, and if you decide to clip the intestine, you might kill the person, and that's just how fragile it is.
I mean, if I'm to reference this, it is now common. Check out Byju's. Byju's in 2021, 2022 was worth $22 billion because of some accounting, finance malfunctioning, and all of those things. Now, Byju's is struggling to survive. And it started from where? Revenue recognition, right? Not being able to recognize revenue properly, thinking that they have more money than they actually do. When you have thought that you have a lot of money and you have recognized the revenue at the top line, you think that it is earned, you can probably think you can do anyhow you like with the money. And at the end of the day, people are saying, I'm not interested again. Please give me back my money. Because they have the right to get their money back. Why? Because you have not fulfill your part of the obligations, right? And before you know it, aside from revenue recognitions, some other things around the numbers and all of those things, even their auditors, which is Deloitte, had to resign at one point. And this is how serious these things can be. And you start to wonder, who are they? Who were in their finance team? Who are leading these things and stuff like that? Now, the last time I checked, Byju's was, I think last year, 2023, between 2021 and 2023 now, the last time I checked, Byju's was probably worth $200 million or less, from $22 billion. From $22 billion, now $200 million. That's over 90% off, right? And this stems from proper accounting, and if you look at many of the businesses that shut down within the last couple of years, even till now, go and check it. How are they dealing with the numbers, right? And it also usually tells from where there is a lack of automation. Because where there are automations in place, because it is a system, if it is designed in such a way that it must follow XYZ rules, when those rules are being flouted, there will be notifications, and you are able to know that, okay, something is wrong somewhere. And one of the things that I personally pride myself as a finance professional is about the fact that even before the auditor comes in, right? Before the auditor comes in, our book are set, right? And I can almost bet that many of our clients, when you come on board and say you are a client and have an audit, we will ensure that all your documentations are available in such a way that if auditor asks for 20 support documents, within 24 hours, auditors will receive all the 20 support documents. And how are this possible? Because of automation, right? How are this possible? Because of automation. So, and this is one of the reasons why personally I'm very much impressed with what Times is doing, because Times is making the life of accountants easy, very easy. And I mean, some people probably say Times can be a competitor to accounting firms, and I'm like, bro, what are you talking about? That means you don't know. It's more or less like you saying AI is a challenge or a threat to you. AI is not a threat or challenge to you. AI is meant to support you and, help you with faster efficiency rates. And that's one of the reasons why personally, even some of our clients now, within this particular previous week, I probably suggested Times to like 3 people when they were asking which accounting software should they subscribe to. And I'm like, see, just go for Times. And they say, what of XYZ, what of XYZ? I know XYZ you are talking about. Guess what? If you do this XYZ, even some of us, we are still going to come back to say, let us help you build a spreadsheet. Whereas you have Times that probably someone will just wonder, how are you going to make your own money? I'm like, see, bro, accounting and finance is very wide. Very, very wide. I've been privileged to work with KPMG China, right? And this is to tell you how wide and far accounting is. So I've been privileged to get a due diligence performed on one of the companies I was representing by KPMG China. And I was working directly with them where they are questioning everything and all of those things. And from there, even the practitioner was very, very impressed. And why? Because the automation that are in place able to make it easy for us to, provide documentation, provide explanation, and make a reason and sense to anybody that is looking at the numbers. And at the end of the day, right, which is one of those things that we now do. See, accounting is data entry. There is the finance part of it that involves a lot of analytical processes and analytical reasoning that you can dwell in and then, and that's one of these things that we are doing now, right? And another thing that we are doing that is very, very big is finance transformation. And part of the finance transformation process is to first get the accounting data right. And that is one of the reasons why we continue to advocate for Times. Because, I've been in situations where, we had a situation on ground where a company's book has been audited and we are still being contracted to come and review the auditor's work. And we are still finding issues, mistakes, errors here and there. And why? Because there is no automation. There is no system for automation in place. If a software like Times is being used that has record and trails of many of these things, then it makes life easy for everybody, right? Even if you're calling me to review, it makes life easy for me because now the review that I'm doing right now is a lot more manual labor than I will have been doing if I'm checking a Times or going through a Times software. Just looking at, how did you manage the numbers here? And the AI that you probably use here, this prompt is wrong. Now, there is a better opportunity for me because I'm telling the prompt that you use here, yes, what the AI said is correct, but the prompt is actually wrong. And that's when we know that there are more opportunities on ground other than...
Yes, sorry that I'm even putting you in here because one of the amazing things that we put into consideration with Times AI is the fact that whatsoever model we are fine-tuning to train this AI, we bring in a feature we call training. We want the experts in the company to be able to train even the time system itself. Whatsoever automation we're doing, we want to release this feature to let you train. So we are also seeing a new set of jobs where we believe there are some experts, there are CFOs that no matter how smart we say we are at times, we can't train this right, or we can't train. Let's look at the real estate company. There are a lot of industries out there with very funny finance. But if you can come into our system and see that I'm a different kind of consultant, I can look at the engine of this software and recalibrate how this thing is managed. There's a training we have that when you upload your bank statement, for example, we can allow you to set up some training for you to use to perform the entry, the extraction of the data and posting for you. But if you're not good, if you're not conversant with automation, with AI, especially what we call prompt engineering, we're living the age of writing code. If you're an accountant and you're unable to learn how to write code, maybe you try learning Python, you could not live. You try learning VBasic for scripting, you could not. Try to understand prompt engineering. Every
Very
solution that will be built on AI today will be built around more of LLM, because LLM will be disrupting the accounting space. Our next alternative version for our time software we're releasing in October is a software with just 4 pages. It's the 4 pages accounting software where you don't need to be moving from pages to perform anything. You just come in and say what you want and it give it to you. You can go to page 2 and train it that this is what I want it to be doing. So right now, you don't need to learn how to code, but new set of people need to develop prompt engineering. This is revenue, because the reason why many people don't get ChatGPT right is ChatGPT is not just about accounting, it's general. So if you believe that as an accountant, I will just sit down in front of ChatGPT and keep writing prompts, you will get error. We've written prompts in ChatGPT before where it gives wrong entry. Accountants say that this thing has given you entry, but everybody say that AI is flawed. But I say that no, AI is not flawed. This is meant to be like, just look at car. There was horse, donkey before. Now we're using car. Even though that car is helping us, we're still the one that drive the car. We're in control of where the car is going. Even autonomous car, it needs to learn from you. What do you want it to be? So right now, this is not about AI being good or not. It's about you yourself. AI has tried its best. How can you leverage on it to become better? Not about, I'm happy that AI is making mistake because it cannot take my job. No, we're getting it wrong. So I think that's just the point we're trying to bring out here. I really, if we're to start discussing about this, honestly, it's a very interesting conversation, and I'm really going to be happy in one of our coming episodes to also bring you here, because I feel like there's a lot of things we can unravel with a lot of professionals like yourself, just to educate our colleagues, business space, in the accounting space, to just see that there is more to what we've been doing. There's more to things that we have in the textbooks of 1960. There's a lot of things that are happening that we will not know the impact today. But there was a time when we were young, whereby our parents, that you were the one that would control the remote of the TV for that. You've been looking like, why is that this generation don't know how to use this simple remote? It's because this generation have already locked themselves up to a system whereby even smartphone is looking very complex. But the same thing is going to happen if we decide to lock ourselves off to be like this system. It's just like a mirage. It's not something that will happen. So I really appreciate your time, and I'm also ready for you to give us some things for the last minute, so we can use as a take home. Maybe some softwares that things you've done, some magic. Let's do some.
Well, I think personally, some of the things that I find interesting that we've been able to do for our clients is being able to leverage Google Workspace to automate the requisition process so much that even in 10 years time, if you are looking for support documents for a particular transaction, in less than 2 minutes, you get it, right? And not just that, we've explored Google platform, and now we've also unlocked the Microsoft platform as well. So we have a client that we are working on finance transformation project for currently, and they've been using Microsoft's platform for a while now. And when we came in, we transformed the whole processes where we are able to help them in such a way that support documentations for all the activities that relates to expenses, assets, paying money, and all of those things automated. And with that, it makes analysis easy. It makes trend easy. And it kind of also ease the life of accountants, business owners, and what have you. And if there is anything that I'm really, really super interested in right now, is to continue to explore times, right? I mean, right now, one of our clients or retainers has been onboarded on times, right? It's currently been onboarded on times as we speak. And we still have a couple of more that we want to onboard on times as we speak. And I can tell you for a fact that I personally feel like, from my experience doing or working on automation, I feel like Reliability Consulting will even be able to use times a lot more than so many other companies. And how do I mean? Let me give you one wonders that people don't pay attention to, that we have been able to pay attention to. So the process of raising a requisition, it can be very fun, and it requires automation. And we know that from times, you have AI that is able to call transactions from your email or from your bank account, from your bank statements, and you just tell it what to do, and it just does it. Guess what? we have been able, which is part of what we do before now, we do in such a way that when you are raising a requisition, right, you raise it through a particular, let's say, Google form, right? It follows a particular approval process and it generates a unique identifier. Do you know what we used to do for automation then? Is that this unique code or unique number that it generated, we then use it when we are making the bank payment. And this is how we eliminate reconciliation issue. So we don't have to struggle with reconciliation. So you see this unique code, when we are making bank transfer, we copy it, put it first before you even write the narration. And as such, right, you are able to tell that when it is time to reconcile, you don't even have issues. X lookup, you are done with reconciliation. B lookup, you are done with reconciliation. And I see this thing working for times as well, where we are able to put that code for different ledgers and we are able to use it when we are making bank transfer, such that once the system recognizes the code, it already knows that this is going to advertisements, and it already knows. And this is something that each time I think about it, I just wonder how people don't really know about these things and don't even know.
I think that's where the importance of we already discussed documentation. That was narration.
Yeah, exactly.
This is one of the power of the forwarding email on times, where it's listening to narration document and it's able to pick reference. It's able to pick reference and subject it to a rule. Now, we also see that if we want to make AI very better, we also need to communicate effectively. If you look at prompt again, that if your prompt is not communicating effectively, you will get the wrong output. So we also see people not using good narration when they're keeping record of transaction. No strategy around you need to find a way to become smart. You want to work with a smart system, you also need to become smart. When you are paying payroll, when you are paying salary, it can be a code XYZ, ABC, 234. Just find a way to also encode your narration. People just take narration for bank is anything. The one I use today, I change this tomorrow. So if we're preparing ourselves for the automation, for the AI system that is meant to help us to make us smart, we also need to become extra smart.
Exactly.
Make it better.
And that's what we have been doing at Ibrahim Consulting. And one of the reasons why I always feel very confident is that we are well prepared for the future. Very, very well prepared for the future. And if there's any final word I'm going to be leaving the audience with, I'll tell you, it's the same thing we see at Ibrahim Consulting. If you are working on a spreadsheet as a finance professional or as a CEO, or let's just streamline it to finance and accounting professional, you're working on a spreadsheet and it's taking forever. Your auditor is requesting for support documentation or support documents and it's taking forever. Just know that you are not doing your work in the most efficient of manners. It can be improved on. And I will tell you, you are better off spending 6 hours learning how to make it or get the job done in 30 minutes than doing the job 2 hours every day. You are better off, right? Spend 6 hours learning how to get it done in 30 minutes. You are better off than doing the job 2 hours every day. Thank you very much, Ibrahim, for having me. Thanks, Times, for all you're doing. I really appreciate it, and I look forward to more insightful and brilliant sessions like this.
Yeah, thanks so much, Qudus Balogun. Really appreciate your time. Once again, I'm Ibrahim Adepoju. I'm the CEO of Times. We are automating financial accounting for businesses, and I say modern businesses and smart CFOs, not just ordinary CFOs. And Qudus Balogun here is building an amazing company at Ibrahim Consulting. They are advocating technology. We have a very strong synergy with them because they are building the consulting firm of the future, and we are building the software of the future. And I believe you will get to learn a lot from these videos, and I really appreciate your time. If you need to learn more, you can visit Ibrahim Consulting on social media, on their social platforms, or you can consult Qudus Balogun. And to sign up on Times is very straightforward. Times.io. You can connect with me on LinkedIn, connect with any of our team members, visit our website to make things better, and let's try to make things smart. So technology is not our enemy, it's our companion. All right, thanks so much for your time. I really appreciate this.
Thank you. Bye for now.